Howdy, Jacob here. Today we're looking at New Skin Enterprises. We have a $950 million market cap with a $1.06 billion enterprise value. It's in the personal care products industry. So, as I can see, pretty good return on invested capital outside of the most 2022. If you look at 2021 and prior, 17%, 12%, 13%, 11%, 10%, 30%, 40%, 11%. So pretty good return on invested capital, very likely well above their weighted average cost of capital. So it's producing business, which is nice. But we are seeing that revenue is actually down from 2013 to 2022, 3.2 billion in revenue down to 2.2 billion in revenue, with a very big decrease from 2021 to 2022. Let's look at some of that debt. So not a whole lot of net debt here. 377 million long-term debt, 265 million in cash equivalents, short-term investments, really nothing. So just under 300 million in cash equivalent like things, and then 377 long-term debt. That's a pretty healthy balance sheet. Nothing too concerning there. Cash flow statement looks good. Payout about 77 million. Looks like they've been pretty consistent with their aggregate payout and dividends. But they've also been buying back shares, so I'm assuming that on a per share basis, the dividend has actually been going up, and it has been about 1.4%, 1.4%, pretty consistently at about 1%. And really, it looks like on a 5-year average, they definitely can afford that. But most recently, they've been running into trouble where they've actually been issuing a tiny bit of debt, nothing concerning, to help fund some of their share repurchases and dividend payouts. But again, on a 5-year average, we're looking at maybe $150 million, 150 million free cash flow. So it's if it's on the lower end, we're looking at 70% payout ratio, so pretty high, up to about 50%. I would say for me personally, I might just keep it flat. I'm gonna say that the $1.56, that's 8% payout. They're just gonna keep that flat. Um, and then the business itself, I mean, it looks like it's declining. Pretty rough. Pretty rough declines there where cost of goods sold aggregate are relatively flat, but revenue's very far down, so their gross margins fallen quite a bit, which we can see over here, 84% gross margin down to 72% most recently. And then on the operating margin side, 17% down to 7%. So before 2022, they were really consistent, producing greater than 10% operating margin. And then now they're upper mid single digits, so nothing great there. I might even cut the dividend down because it looks like the most recent period's just really rough. So let's see. They develop and distribute various beauty and wellness products worldwide. It offers skincare devices, cosmetics, and such. Okay. All right. I might cut it 25%. So that'll have them paying out roughly high $50 million on the dividend, which um, if they go back to the 100 million that they're paying out, that's a 50% payout ratio. Then they can focus the rest on buying back shares that are hopefully cheap. But the business itself, I might say -1%, 9 on the PE, price to free cash flow. Margins have been going down, but I'll still probably take an average for an initial assumption. Let's do 5.5, and then maybe 6, and then 5. Share change should have been buying back a bit, but still gets us to a price that needs to fall 35% before you get a 15% return, given these assumptions. I think the 8% yield it has right now is a fantastic yield. We are looking for greater than 4, so they could even cut that in half, where the payout would be about 39, 38 million, and they could definitely afford that given their historical averages. But it is a declining business, it appears, and I definitely would want to do more research into this company. The ROIC looks pretty great, but like I said, there's not a lot of reinvestment back into the business. It's usually, or it's split pretty evenly between dividends and paying down shares, which, um, if you're not reinvesting back in the business, there shouldn't be a premium on PE or price to free cash flow because they're not using any of that excess to get you the excess free cash flow to get you that excess return. So if they were reinvesting, it looks like they could, get a 12% or so return on that money. But they might just not have any place to invest in that they find worthwhile. And that's why they've been paying out dividends, buying back shares, which, again, nothing wrong with that for the type of business it is. But then it doesn't deserve a premium because they can't reinvest at those high rates. That they've historically seen. So for me right now, I'm just waiting it out. I think it is a pretty solid dividend stock. It looks like they've been paying out a dividend for quite a while. But again, the business itself has declined quite a bit in the last couple of years. So I want to make sure that that dividend could hold. Even if they cut it in half, that's still a 4% yield, well above average, well above the market average, and something that we're still looking for. But again, right now, I'm just waiting for it to fall a bit more before I do further research on it. Thank you so much. Hope you have a good rest of your day.